Good morning, students. Welcome back to the session on intelligence. Today we are left with some part of this intelligence 37. So we are continuing with intelligence 37, and as per the schedule, we also need to start with intelligence 202. So very soon after completing this small part of intelligence 37, we will start with intelligence 202 as well. All right. So let us quickly start with the remaining part of intelligence 37. And before we get on to that, we just do a small illustration quickly, and this will also help us in taking a sort of a recap of whatever we have discussed. So all of you can just quickly move on to illustration number 15 on page number 9.121. Illustration number 15. Okay. A manufacturer gives warranties at the time of sale to purchasers of its three product lines. Under the terms of the warranty, the manufacturer undertakes to repair or replace items that fail to perform satisfactorily for 2 years from the date of sale. So there is a product for warranty which is available, and the product warranty is for 2 years. At the end of the reporting period, provision of rupees 60,000 has been recognized. So this is already recognized. The provision has not been discounted, as the effect of discounting was not considered to be material by the management of the company. You are required to draft a note on this. Yeah, very simply, if you are required to draft a note, so how will you write this? This is all about disclosures. The disclosures is again not something which is a very big area, or I would say very, very important area for all of you to get into. But in plain, simple English, whatever the management has done in terms of recognition, measurement, yeah, by bringing out both these aspects, if we can draft simple language, that will be good enough for considering a good note in the exam. Okay, so let's just try to read this as to how this note can be drafted. A provision of rupees 60,000. So when we say a provision, means recognition is there. Of rupees 60,000 means measurement has also been clarified in the note. Has been recognized. So now we are putting it down in the note itself that provision has been recognized. For expected warranty claim on products sold during the last 3 financial years. It is expected that the majority of this expenditure will be incurred in the next financial year, and all will be incurred within 2 years from the reporting date, or from the balance sheet date, or we can say after the reporting period. Okay. Now, at times, we may also be required to draft a note like this. So, whenever any requirement comes for drafting a note, note means whatever disclosure will go into the notes of accounts. There are few things which we need to always remember. Our note should clarify the regulation. Okay. So whatever thing is getting recognized, note should give a clarity on that. Secondly, measurement. Measurement should also be clarified as to how that particular amount has been measured in the financial statements. And at times, if that is very peculiar, I'm not talking about note related to India 37 only, this will apply to any sort of note. If there is anything specific in terms of the presentation, note should also bring out that aspect. So while drafting a note, we need to take care of these 3 things. Okay. If you are taking care of these 3 things, then whatever note you will draft will be considered to be good enough. Many a times you will have a query. So do we need to write the note exactly the way it's written in the study material, or how do we draft in terms of language? Do we need to use very, very technical language? Do we need to give the reference of the standard? All of those things are not required. Only these three things you need to remember. And in fact, this one also, when this is something which is peculiar, or something which is very, very specifically required to be brought out. Otherwise, these two aspects are important. Okay, yeah. So if you remember these two aspects, that will be considered to be good enough in terms of drafting. Fine. All of you clear on this? Perfect. So now we will move on to another guidance is the standard purpose, which is on levies. I would say this is again not something very, very important, or I would say this is again something, a very small part of the standard. This is actually an input, or you can say an interpretation, which is now forming part of the standards in the form of appendix. That's why we see it over here. Otherwise, this is not really part of the standard. Actually, it's an appendix for which guidance is given along with the standard. So that's why we are covering it along with the standard. So let's understand what does it talk about on levies. So this appendix on levies deals with accounting for a liability to pay a levy if that is a liability within the scope of India's levy 7. So you all can move on to page number 9.1. And as I told you, this is not something which is important, but yes, it will be good to just go through this topic for the purposes for understanding only, because in the exam you never know, people can pick that. Secondly, this is dealt under this appendix if the accounting for a liability to pay a levy is certain. Okay, to pay a levy is a certainty, so uncertainty should not be there. That means its timing and its amount, both of them should be certain. Only then it gets covered under this appendix, otherwise do not. So let us now try to understand what can be a levy which is getting covered over. A charge imposed by government on entities in accordance with laws and regulations, which leads to outflow of resources. But now this aspect is very important. What does it exclude? It excludes outflow of resources if those are covered by any other standard, fines or penalties. So when we talk about the levy, we are not talking about fines or penalties, which are there for breaches of any type of law or statute or legislation. Payment made to the government for acquiring assets or for rendering services as per the contractual arrangement. Liabilities that arise from efficient payment scheme. So these four things we need to exclude, and the remaining part which will be there in terms of making a payment to the government as against any required, as per the requirement of any law or regulation which is imposed by the government will get covered over it. So let's pick up some example for this. Example number 35. If the activity that triggers payment of levy is generation of revenue in the current period, and calculation of that levy is based on revenue that was generated in the previous period, the obligating event for that levy is generation of revenue in the current period. The generation of the revenue in the previous period is necessary but not sufficient to create a present obligation. So let's try to understand how can this really become levy. So let's suppose we have got these two financial years. So this is 1920, this is 2020. Now government imposes, let's suppose, a levy at the rate 1% on the revenue of the company. So that's the arrangement. Correct? Or you can say that is the legislation. Now in this scenario, if the revenue of the company, let's suppose is 100 CR in 1920, and this let's suppose was on to 150 crore in 2021. Now for this levy to be imposed, what is it that the government will check? Revenue of the last financial. Okay. Now for this year, if there is no revenue, will this levy arise? No. In this financial year, this levy will arise. But this will be based on this financial year's revenue numbers. Correct? Yeah? And when I say in this financial year it will arise, it will be the payment that will be required to be made in respect of this levy. Okay? Yeah? Now, another thing which is required to be considered is that such type of levies or such type of amounts are not required to be paid as per the contractual arrangement. So there is no partnership arrangement that we are looking at. There is no royalty arrangement that we are looking at. It's something which is imposed by the government and which is getting paid to the government. And what will be the government? Government means the government, which will be the state government, central government, government agencies, all the bodies, or you can say the government bodies, for example, local authorities, etc. Correct? Clear on this? So this is something which will form part of levy. Now, as regards to recognition, what do you need to consider? An entity shall apply same recognition principles in interim financial reports. So let's suppose if the entity is doing interim financial reporting, it will apply same principles on levy that it will follow in case of annual report. So say for example, for 2021, entity is doing interim financial reporting. Let's suppose entity is listed. So every quarter this is required to give its results. Now for this interim period, the same type of accounting for the levy will be done, which the entity will be required to do for its annual financial statements. So as regards to recognition is concerned, in terms of interim financial reporting or in terms of interim period, there is no exception. Fine? Clear? Yeah? Now, as regards levy, as I told you, it's only the basic understanding about it that we need to get into. We don't need to get into too much details around it. And I would say only this much understanding to get in the exam, that should be good enough. Yeah? So without getting into too much details around this, now we will move on to the closure of the standard, and which can be best done with the help of differences. So we are done with this in days 37 now, and I understand that you have understanding of the Indian gap. So now it's up to you. Basically now it's over to you. When you need to tell me some of the new things which you would have learned under this Ind AS and which did not exist under accounting standard. Or other than this, if there are any differences which you would have got to know. Yeah. Okay. So now you need to tell me the gap differences. So basically we are talking about gap differences between Indian gap and US. And please remember that in the exam it's possible that when you get questions, you may have to consider these gap differences also. The gap differences again very, very important area. So that's why it's very important that you go through the gap differences carefully and you should have a thorough knowledge of the gap differences. So over to you. So what are those gap differences which we can discuss for Ind AS 37? Yes, over to you quickly. Tell me the gap differences. Huh? quickly gap differences, and this is something which you need to do without looking at the study materials. Yes, Vicky, over to you. What are the gap differences? Waiting for a response. Yes, quickly. Yes, I'm waiting for a response. Gap differences are? So Vijay Rashmi Singh, present value recognition is not there at the accounting standard. Very good. So now under Ind AS, as we have discussed, whenever we measure means whenever we measure a provision, because provision is something which is recognized and that is required to be measured. So under accounting standards, under Indian GAAP, we don't consider the present valuation. But under Ind AS, present valuation is important. That is required to be considered. Yeah. So it's a good example. Meena, I think you need to check it at your end at least, because I understand that audio is all clear, and you may all please confirm audio is all clear. Yeah. I got it checked. So everything seems okay. Maybe you can check it at your end. Okay. So she is saying onerous contract is entirely new concept. Great. So you're saying that's a gap difference. We'll come to this. So he is saying discounting technique. Very good. Radha is saying there's no concept of onerous contract. Okay. Any more differences which come to your mind? And please remember that you don't need to get into the study material. Otherwise, that will not help you. Okay. Kalyani is again talking about the onerous contract. All right. What about others? Okay. So 2 points you have shared with me. One is about the present valuation technique, which was not there in the accounting standards, which is correct. Second is about the onerous contracts. Yeah. Okay. Anything else that comes to your mind? Yes. Anything else that comes to your mind? Okay, so let's move on to some gap differences. Other than what you have already discussed with me in terms of onerous contracts and the discounting technique, which is correct. Contingent assets. If you remember, we talked about contingent assets. Yeah. Now, when we talk about contingent assets, we discussed that there is a requirement for disclosure of contingent assets. These are not recognized. There is a specific guidance. In fact, detailed guidance on contingent assets, which is available under Ind AS 37. But when it comes to accounting standards, contingent assets are not even disclosed in the financial statements. They are only required to be disclosed in the board of directors report. They are only required to be disclosed in the board of directors report. So that is a big gap difference. Okay, I think Kalyani has raised the same point. Okay, then Swishi is saying this concept of levy is a new inclusion. That is again a very good point, because even though we say this levy is in the form of an appendix, but this is very much a part of the standard now in the form of an appendix. But no such interpretation or no such guidance on any type of levy exists under accounting standards. So this is again very good that this is also a gap difference. Correct? This is also gap difference. Okay, anything else? When we talk about future operating losses, so I'm looking at the study material only. When we talk about future operating losses, we discussed about it that under India's 37 there is an exception to this principle. What's the exception? That such losses relate to an onerous contract. This is something which was considered in cases of an onerous contract. Yeah. When it comes to accounting standards, AS 29 states that identifiable future operating losses up to the date of restructuring are not included in a provision. Correct. Which is also similar thing under Ind AS, but the only aspect which gets added to this is its consideration under onerous contracts. Then, moving further, talking about some of the specific things which exist under Ind AS. One is, of course, levy. Second is, under Ind AS, there are a few aspects which are covered. One is about this decommissioning liability. This has been specifically discussed in detail and which is not discussed under accounting standards. Yeah? And why is that discussed? Because that is very much a part of a provision in the financial statements of a company. Liabilities, if those are arising from participating in a specific market, waste, electrical and electronic. But now this is again one area which has not been discussed, so it is not required at your level, but for which guidance also exists in Ind AS and which is completely not available under accounting standards. So that is again one sort of gap difference we can see. Another thing which is a very, very small difference in terms of its understanding, but this is considered to be very important, and this is around constructive obligations. Earlier, there was no concept of constructive obligation under Indian. AS 29 requires creation of provisions in respect of constructive obligations now. Why do I say now? Because now AS 29 has also got revised few years back. Earlier it did not exist. So we are not saying that this is a gap difference in totality, but this has been discussed. However, it requires creation of provisions arising out of normal business practices, customs, and a desire to maintain good business relationships in terms of the constructive obligation. Means out of these things, any constructive obligation which arises is required to be recognized as per accounting standard. Whereas, if we go to Ind AS 37, Ind AS 37 also requires consideration of constructive obligation. Yeah, this also requires consideration of constructive obligation. And this constructive obligation consideration has been discussed in detail over here. When we talk about definition of provision, obligating event, all of these have been covered in detail under Ind AS 37, while the terms legal obligation and constructive obligation have also been discussed in detail under Ind AS 37, which is not the case for Indian GAAP. If we talk about portion of existing AS 29 pertaining to restructuring provisions, that has also been revised under Ind AS 37. So when we say these are all aspects which have been revised, you can say this is something which is available in the form of a specific guidance and a detailed guidance under Ind AS 37. So conceptually, in terms of the terminologies, both the terminologies exist. So we are saying as a concept, both the items are available. Constructive obligation as well as if we talk about this obligating event, etc. All of these terms are available under both the standards. It's just that a detailed guidance is available under Ind AS 37 for this, and which is not something in so much detail under India. Okay, yeah, clear on this? So these are some of the gap differences, and as I told you, that gap differences are very important, and this is not only important for the purposes of your examination, but practically also you will require this in many situations. Huh? So now with this, we come to an end to our discussion on India 37. I'll just do a quick recap of whatever we have covered. In terms of India 37, basically there are three things which we need to remember: provision, contingent liability, and contingent assets. What is a provision? Provision means something which is probable. What is contingent liability? Something which is possible, means which is 50%. And provision is more than 50%. Okay. Now, as regards the contingent asset is very much on the lines of contingent liability in terms of the contingency which is attached to this. And similar to contingent liability, this is only required to be disclosed. This is not recognized. Okay. Further, on to provision. If we talk about the measurement criteria, provision is something which involves uncertainty, which is based on approximation. So that's why it's subject to change. And that's why whenever it is measured, an estimate is required. But the estimate has to be the best estimate, and wherein present valuation technique is required to be applied. So you should just think that present valuation technique will always be applied over there, except for the materiality aspect. Yeah, and materiality aspect is not something over which you will get into too much detail, because that information should be available to you in the exam. Otherwise, you will always consider that to be material, and you will always consider that for discount. Okay, yeah. So these are broadly the things which you need to remember. Then I can see one flow chart. I can see one flow chart of a decision tree, which is available on page number 9.125 of the study video. You can just mark it for the purposes of your revision at the time of examination. This decision tree, I can see, covers various aspects of the guidances which we have discussed. Because as we have discussed, at the time of examination, you will need summaries, you will need short notes. So this decision tree covers various aspects and you will be able to just quickly revise. Okay? Clear? Yeah? So with this, we come to an end to this chapter, and I would suggest all of you to practice the remaining questions of this chapter that we have not discussed, though we have tried to cover various questions, but the remaining questions that we have not discussed, you should try to practice it. And before we move on to the next topic, if you have any questions, any doubts, let's discuss that now. I understand some of you have queries related to questions also. We can also discuss that now before we move on to Ind AS 102. So after discussing your queries, we move on to Ind AS 102. Okay. Quickly, if you have any questions, any doubts around this, please let me know. Yes. Any doubts in case you have on Ind AS 37, we can have a discussion on that now. Take to be quick, please. No doubts? Alright, so then we can move on to Ind AS 102 now. Yeah? Okay, great. So let's move on to the next topic. Ind AS 102, which is about the share-based payments. You can say this is one of the most important Ind AS, practically as well as for the purpose of your examination. This is also considered to be typical at times, but this is not really so typical. This is quite easy, and that is also something which we'll see during the course part of the session. But for the purpose of your examination, you can consider this Ind AS to be important. Now, this Ind AS has also got significant differences as compared to Indian GAAP. The way accounting is required to be done currently under Indian GAAP has got significantly changed when we look at the accounting that is available under India. So that's why this standard becomes more important, because now the accounting has changed in Indian governments. Before I talk about this standard in too much detail, let's try to understand the coverage of this. Means what does it cover? This standard talks about share-based payments. Okay. Share-based payments. Have you heard about ESOPs? Many of you would have dealt with ESOPs. Not only theoretically but practically also. Okay. And I'm sure at intern level or maybe during your graduation also, at some point of time you would have covered ESOPs. Can you share your understanding of ESOPs? What do you mean by ESOPs? How have you really dealt with ESOPs? Quickly. In the meantime, I can see a couple of queries from Vijay. Vijay is saying, can I ask question later to in this chapter? Of course, at any point of time you can ask. There is no time foundation. No problem. At any point of time, feel free. Chalika is saying, as per the exam concern, we remember these differences, means the gap differences. But the other standard which we did in the class till now, these differences were not discussed. No problem. So, there are two ways to discuss the differences. One is, of course, when you are covering a topic, along with the topic, you also get to know as to how the accounting is done in India. Or maybe after that, you can just cover the gap differences. Okay? It's either way. But gap differences are important. And please try to understand why this is important. Because in today's scenario, in India, we have two sets of accounting standards. And there are, you can broadly say, two categories of companies. One category of company on which accounting standards will apply. One category of company on which Ind AS will apply. Only two categories exist. And it is not that you will be only required to deal with companies on which Ind AS is applicable. You may also get to deal with companies on which accounting standards are applicable. Yeah? So till the time you don't have thorough knowledge of both of them, until the time you are not able to differentiate between these two standards, you will not be able to, follow the accounting principles in the right manner. So that's why it's important to have an understanding. Okay, Radha is saying that share options which are given to the employees are ESOPs. Shraddha is saying it's an option which is given to an employee to purchase the shares at a price less than the market value to make the employee participate in the profits of the organization. Very good. So what is ESOP? Employee Stock Option Plan. Employee Stock Option Plan. Now what does it mean? So let's suppose there is a company who is got employee. Now, this employee has been working for the company for the last few years. Yeah? And the company wants that the productivity of the employee is required to be increased. It's not that this employee is not working efficiently. He's working efficiently, but the company wants that he should work in a more efficient manner. Okay. So for this employee to work in a more efficient manner, what do we need? We need to give him some incentive. Because already he's getting salary, he's getting bonuses, everything he's getting. But some incentive needs to be given so that he can increase his productivity. Now, what is that incentive which the company can provide to him? One of the ways to give the incentive is in the form of ESOPs. ESOP means company will now call the employee, have a meeting with him, and will tell him that we will watch your performance for next 3 years. Next 3 years is not the requirement as per this standard. I'm just using an example of 3 years. So now company's management and employee are having a meeting, and company's management is telling the employee that we want you to perform more than what you have been doing. And this should continue for next 3 years. If you will perform at the desired level means at some level which the company will set for you. So there will be a measurement criteria for his performance. Some benchmark will also be established. If you continue to perform at that level for the next 3 years, then what will happen? Company will give the shares. Company will give its shares to this. Let's suppose currently the share price of this company is rupees 100 in the month. Okay. Currently the share price of this company is rupees 100 in the month. And it is expected on the basis of the performance of the company, not the employee, on the basis of the performance of the company, that this price by the end of 3 years should touch around 200. Or even if it doesn't go up, this will at least remain within the range of 100 to 200. Okay. Now, let's see the motivation, the incentive which was from the company to the employee. So company has offered that if the employee works at the desired level, company will provide its shares to the employee at the rate rupees 20 only. Means the share which is available in the market for 100 now and which is expected to touch 200 after 3 years, or even if it doesn't go up, it should remain at least 100, will be available to the employee at this point, which the employee can sell at any point of time after the shares are given to the employee. So will this be a big incentive to the employee? Yes. Yes or no? Do you think it will be a big incentive for the employee? Yes or no? Yeah. So I can see similar sort of responses from ICAI and Sushi. Great. Now, let's understand how will this incentive work. Now the employee will raise the bar. He will start performing at higher level. Yeah. Now, the employee will work harder. because he understands that at the end of 3 years he will get this share. But let's look at it from the company's perspective. From the company's perspective, what has happened? Company has promised to give its share, let's suppose, which is a worth of rupees 100 and rupees 20. By issuing one share to the employee, what is it that the company will lose out? At least rupees 80. So that means over this period of 3 years, this will be a cost to the company. 80 is the cost to the company. But this cost will arise to the company only if employee fulfills the condition of this plan. Correct? Employee fulfills this condition of the plan. Yeah. And the most important point, and please mark it up, the most important point, which this entire arrangement carries, is the linkage of this incentive to the shares of the company. At every point of time, you will see one thing, and which is the most important, that this entire incentive is linked with the shares of the company or share price of the company. Why is this beneficial? Because this is linked to the share price. Correct? Yeah. Now, what do you mean by share-based payment? Now I am coming to share-based payment. Now I am moving from ESOP to share-based payment. Share-based payment means contractual arrangement between two parties, wherein one party will make the payment to other party, and the payment will be linked with the shares of the first party. So that means, what do we mean by share-based arrangement? There are two parties. Let's suppose company, and this is another party. Say party. So there must be a contractual arrangement between these two. In which case, company will be required to make a payment to another party, and the payment which this company will make to the other party will be linked with the shares of this company. Only if this condition is fulfilled, I am repeating this point, only if this condition is fulfilled, that will become a share-based payment. Now, it's not necessary that company is required to make the payment in cash. Payment could be in any form. But whatever form it carries, that form should have linkage to the shares of the company. Getting it? Yeah? So now, with this limited understanding that I have given you, can you please tell me, all of you, you need to answer this, please. Can you please tell me whether ESOP can be called as share-based payment or not? Quickly. Satish, you need to check it at your end, please. All of you, I'm just hoping that the audio is all clear. Yes. Quickly. Whether ESOP can be called as a share-based payment or not. Quickly. ESOP can be called as a share-based payment or not. Yes, I'm waiting for the response. ESOP can be called as a share-based payment arrangement or not. Vijay is saying yes. Pranav is also saying yes. Mayur is saying yes. ESOP will be a share-based payment arrangement. Shalika is saying ESOP which is given to employees also called as share-based payment arrangement. Okay, very good. Okay, now. Srishi is also saying yes. Very good. Okay. So now, let's try to understand how is this Ind AS different from Indian GAAP. Okay, for the purposes of your reference, you need to know this. As I told you, that GAAP differences are important. When it comes to Indian GAAP, only ESOPs are covered over here. If any of you would have covered ESOP under Indian GAAP, there's a guidance note which talks about accounting of ESOPs. There's a guidance note which talks about accounting of ESOPs. And the guidance note covers accounting of ESOPs. Guidance note doesn't talk about share-based payments. Correct? Guidance note doesn't talk about share-based payments. But we now need to know how are these two terms different from each other. So let's try to understand this. We understood that for a share-based payment arrangement, two parties are required. One, a company, second, a party. Now, did we ever discuss that this other party has to be an employee? For the purposes of Ind AS, we did not discuss any such thing wherein this other party has to be an employee. So we can say this other party could be an employee. If this other party is an employee, then we will get this example of ESOP. If the other party is an employee, we can give an example of ESOP. That will become a share-based payment arrangement. But at times, it is also possible that this other party is non-employee. Non-employee means not an employee. For example, it can be a vendor of a company, or you can say creditor of a company, or you can say supplier of a company. And you may be thinking, sir, how is it possible? Let's try to understand. Say if a company is purchasing goods, yes, I am talking about purchase of goods only. Say a company is purchasing goods from a vendor, from a supplier. And when the payment is made to that vendor, then instead of paying cash, company is issuing its equity shares. And you will be thinking, but sir, this doesn't happen practically. That's true. But if that arrangement exists, whether it will become share-based payment arrangement, let's try to think about it. What are the conditions? Two parties should exist, company and vendor conditions. What is the second condition? That when the payment will be made, that should be into the shares of the company. Is that condition fulfilled? Yes. The moment that condition is fulfilled, it will become share-based payment arrangement and it will be dealt with by this Ind AS 102. Clear? Yeah? Clear on this? Now, this is the most important difference between Ind AS and Indian GAAP. Indian GAAP doesn't include in its purview non-employees. Indian GAAP is only dealing with employees, whereas Ind AS is not limited to employees, it's going beyond employees. Clear, all of you? Yeah, about this difference now. So I would suggest if all of you can go to page number 5.34 now of the study material. and quickly read the definition of the share-based payment arrangement. It's an agreement between the entity and another party. Entity is this and another party. Means it could be any other party. That entitles the other party, which the other party does, to receive cash or other assets for amounts that are based on price of equity instruments of this company, or this other party will receive equity shares of this company. Okay, yeah. Now you have understood the meaning of share-based payment arrangement. If you have any questions, any doubts around this arrangement, please let me know. Because this becomes the basis for us to move on to this end. If there is any doubt around the understanding of this arrangement, please let me know. It's very, very important. Because in this standard, as we move further, the only thing wherein you will struggle would be an understanding of share-based payment arrangement. Because there is something new. Why? Because this includes other than employees. Quickly. Are you all clear on this? In the meantime, I think Surya, Manan, Shraddha, they all showed their responses. Very good. Vijay is saying we are all clear, sir. Let us further. Find this term is understood by all of you. You are all clear on the meaning of share-based payment arrangement? Yes? Okay, so let's move on to some examples of share-based payment arrangement. Okay, Mayur has a query. Mayur is saying, sir, payment should be linked to equity, but not specifically equity has to be given. Yes. Either the equity shares may be given or the payout which goes could be in the form of cash or other assets, but that other payout has to be linked with the equity shares of the company. That's a must. Pranav is saying, sir, what do we mean by another group entity? Please wait for that. Please don't get into it. Just keep it very, very simple that two parties are involved. Who are the two parties? Company and other party. The remaining part of the definition I have not discussed. So please don't get into it. We'll go on to that slightly later. Okay? Kalyani is here. Shita is saying, it's a difference between ESOP and share-based payment arrangement is in the earlier one includes employees and the latter one, yes, that's correct. Now the new guidance note covers that one also, but for the purposes of your understanding, yeah, for the purpose of this current study material, that difference still exists. Okay, so you will not go on to the latest guidance note which has come because that has not been updated in your material. So your material still carries those differences. Yeah. So if you go on to the end, Shraddha, yeah, if you look at the gap differences, it's not something which is covered, the latest one. So that's why please don't go into that. You will still carry the old one for the purpose of your discussion. Okay. Clear? Okay, so she's asking, sir, they also will have an ownership management rights as that of equity shareholders? Yes. So after 3 years, as we discussed in our example, when this other party will get equity shares, when they will get equity shares, not today, after 3 years, when the condition is fulfilled, then they will also become the shareholder. Okay. Now, basis the shareholder of the company, whether they will get management rights or not, that will be dependent on the arrangement. But yes, they will become shareholders. Fine. Okay. Now, we'll pick a few small examples about the share-based payment arrangement only. Yeah. So let's move on to this example number 1. A management committee of an entity has initiated a plan to provide some stock options to its employees, but there are some terms which are yet to be finalized and plan is not yet communicated to the employees. Since there is no formal communication stating the terms or conditions of the agreement, it will not attract in AS 102 provisions. The standard will be attracted when there will be a finding. Now, what does it say? Between the company and the other party, as we discussed, what was the first condition? There should be a fund. Agreement. If no communication is made by company to other party, can we say an agreement will exist? No. So till the time it's not communicated, can we say that share-based payment arrangement? No. And if it's not a share-based payment arrangement, will Ind AS 102 apply? Okay, simple. Kalyani is asking, sir, when we say linked to shares means the consideration should be equal to shares value, but it can be paid in cash also. Is that correct? Yes, that's correct. Okay, moving on to next example. Example number 2. Goods and services have been received by an entity for which it has issued its own equity shares to the counterpart. Means to other party, shares have been issued by the company. And these shares have been issued at discount or premium. The value of the goods received has been paid by using its own equity shares, but if the fair value of the goods received are more or less than the value of the shares issued by the entity, then some unidentified goods or services will be received or have been received. Hence, Ind AS 102 will still be applicable for such unidentified goods or services. So we are saying that it's not necessary that the shares which are issued by a company to other party should match with the fair value of goods or services which are received. There could be a difference between that. Okay. An entity issuing its own shares for charity without consideration will also be covered under Ind AS 102. Okay. Moving on to the next example, number 5. An entity issued right shares to all of its shareholders, which includes employees of the company. Since the employees who have received such shares have received those shares in their capacity as shareholders of the company and not at employees, should this transaction be covered under Ind AS 102? Force. Why? Because this other party must supply some goods or services to the company, against which company will make the payment. When a company is coming up with a right issue, and right issue is offered to all the shareholders of the company, has the company received any services from the employee who is the shareholder of the company as regards their right shares? So what is that arrangement? That's a normal arrangement in terms of issuing the right shares. That is not something which will be called as share-based payment. For a share-based payment arrangement, it's necessary, it's a must that company receives goods or services from the other party. Okay, clear on this? You can pick up one more example. Example number 7. This is page number 5.36. A stock option has been issued by an entity to its employees, those who remain in service for next 4 years. So what's the condition? Employee remains in service for 4 years, and then he will get the stock option. Those who leave before 4 years will not get the share-based payments. Staying with the organization for 4 years is a condition. Forget about vesting. Is a condition in order to get share-based payment. Correct? Yeah. So will this be a share-based payment arrangement? Of course. Pranav is asking here, we can say that payment is purely linked with the index? No. Payment has to be linked with the share price of the company. There is no index which you need to consider. It's only the share price of the company. Okay. Now, so far, all of our discussion must have, brought this clarity about certain conditions which are a must for any arrangement to be called as share-based payment arrangement. And I'll just quickly repeat those points. First condition, there has to be a contractual arrangement between company and another party. First. Second condition, other party provides goods or services to the company. Third condition, company makes the payment to the other party in respect of those goods or services, and the payment could be in any form, but that payment has to be linked with the shares of these three conditions. Then you will note down these three conditions. If these three conditions are fulfilled, then this is something which is a share-based payment arrangement. Mayur has a query. Mayur is saying, so transaction will be recorded as fair value or share value given up, and then how about difference in value? Please hold on to this for some time. As we move further, we'll talk. Okay. Then we'll get on to the measurement principles, we'll talk about it. Swish is saying there has to be vesting condition mandatory. For the time being, you can say these three conditions are true. Forget about vesting, non-vesting. I am not discussing about vesting, non-vesting at all. So don't get into it for the time. Okay. As we move further, all of these terms will keep coming. Shraddha is saying, actually, could you please explain a bit about it? Why there is a separate standard in DAS 19 apart from this in DAS 22? So there's a huge difference between these. A big difference. In DAS 19 talks about employee benefits. Okay. Employee Employee benefits means employee is rendering services to the company and company is making payment. When only this much arrangement exists, which standard do you look at? Ind AS 9. The moment payment made by the company to the employee will be linked with the shares of the company, it will no longer remain under Ind AS 9. It will move to Ind AS 9. Understood, Shazam? Yeah? Understood? It will move to Ind AS 102. Okay. Clear on this? Okay, Gopinath is saying charity condition of receiving goods or services are not met. So how do we share this development? I'll talk about it as we move further on this aspect also, Gopinath. One time we will say a company is incurring an obligation in the form of this charity, so that's why it's getting covered. Okay. Now let's move on to understand what is it that we will not cover under Ind AS control. Transactions with shareholders as a whole means when a transaction is made with a shareholder and that transaction is carried out with the shareholder while the shareholder is acting in its capacity as shareholder of the company and not otherwise, then such a type of transaction will not be covered under Ind AS 102. So let's understand this with the help of an example. Let's move on to example number 12. If an entity grants all holders of particular class of equity instruments the right to acquire additional equity instruments of an entity at a price that is less than fair value of those instruments, and employee receives such a right because she is a holder of equity instruments of that particular class. Granting or exercise of that right is not subject to or will not be covered under Ind AS 102. So there is a company. This company came up with the right issue. And before right issue, who were the shareholders of the company? Current shareholders. Shareholder 1, shareholder 2, shareholder 3, shareholder 4, shareholder 5, shareholder 6. There were 6 shareholders of the company. Okay. Out of these 6 shareholders, these 2 were also the employees of the company. And when this right issue was made, this went out to all. Now in this case, when we talk about these 2 employees of the company, who will now receive equity shares of the company. So why are these receiving those equity shares? And they rendered some services to the company. Is this the reason for issuing equity shares to these employees? Why are they receiving the equity shares and that too at a price which is lower than the market value? Because they were the equity shareholders. So in their capacity of shareholder, they have become entitled to this right issue. So can this right issue therefore get covered under Indians 102? All of you, please answer quickly. Yes, quickly. No. Very. So Desh is saying no. Very. So now moving on to the next example. An entity has issued equity shares in exchange for control of acquiring. This is not within the scope of this thing. See, even if I am discussing all of these examples, you must appreciate the fact that if you go back to three conditions that I have discussed with you, all of these examples will automatically get excluded. So that's why even though I am discussing these examples, don't think that these are new concepts I am discussing with you. All of these examples I am discussing just to clarify the concept. So the concept still remains one, which has got three conditions. Okay. Now what is this next example? A company has acquired controlling. So this is company A and this is company B. So company A has acquired 70% shares of the company B. Means control of company B is acquired by A. And for acquiring this control, company A issued its shares to the shareholders of company B. You see, that is how they will get the control. Company A will pay something to the shareholders of company B. Will it become a share-based payment arrangement? Quickly, tell me. Do you think it will become a share-based payment arrangement? Okay, so the previous one is now answered by Manan and Shelter. They are saying no. Quickly, we can talk about this one also. Will this get covered? No. Why? Because this entire arrangement doesn't have any flow of goods or services. It's something which is going out to shareholders of B because they are acting in their capacity as shareholders. Okay. Next example. Example number 15. Contract for purchase and sale of goods or services which are entered for selling net amounts or keep it for speculation purposes will be covered under Ind AS 101. And hence it will not be covered under Ind AS 102. Okay, so now if there is something which is already covered under Ind AS 109, what is that? Contract for purchase or sale of goods or services, which is covered under Ind AS 109, or which is for speculative purposes, which is again covered under Ind AS 109, will not be dealt under Ind AS 102. Okay. You and Shilpa have answered this question also. Kalani is saying that means once the company issues shares under this index, then going forward the party gets excluded from this standard since now that party will be a shareholder, not necessarily. Not necessarily. Say company A is coming up with the right issue. And we discussed there are shareholders S1, S3, S4, S3. When this right issue goes to these two, will this be a share-based payment arrangement? No. But let's suppose These two are shareholders of the company, and these two are also the employees of the company. These two are shareholders of the company, and these two are also the employees of the company. Now, company has come up with another arrangement wherein a scheme, a plan is offered to these two employees that if they stay as employee of the company and there are certain conditions which are required to be fulfilled by these employees, then they will become entitled to more shares. So can we say that such an arrangement will be in place for the two arrangement? The answer is yes. Why? Because those shares will be offered to those employees of the company while those employees are not acting in their capacity as shareholders, but while they are acting in their capacity as employees. Okay, now clear on this, Kalyani? Yeah? Are you clear on this? Yeah? Gopinath, I am hoping that you are now clear on this because I think your query by chance related to this one. Gopinath, Kalyani, you are clear on this now? Please confirm quickly that we will move on to the recognition part. Then we'll move on to the recognition part of this details. This details is very, very relevant to today's scenario because these type of arrangements are very commonly seen in case of various corporates, and this is quite interesting also. Question is asking that this means share issued to those who are in the position of shareholders are not covered under India's majority. That's true. But it's not about those who are in the position of shareholders. Along with position of shareholder, if the arrangement involves those shareholders acting in their capacity as shareholder, and then they are getting equity shares, then it will be excluded from interest. For example, as I told you, this one is excluded, but same company offering a plan to employ, plan to S4 and S5 will get covered under interest. So it's not that shareholder will get excluded from Ind AS 102 forever. Shareholder will get excluded from Ind AS 102 when the arrangement will be such. When the arrangement will be such wherein he is acting as shareholder. Okay. Kalyani is clear on this. Question I am hoping you are clear. Shalika is asking because there are existing conditions are so it is called as share-based payment arrangement. That's true. Gopinath is saying my query is on co-acquiring exam. Gopinath, you need to please clarify on your query. Just give me 1 minute. Just give me 1 minute. We need to clarify on your query. Just give me 1 minute. Yes. Question is clear, Gopinath. You can just elaborate on your query, please. Alright, so in the meantime, we'll move on to recognition part. For the purposes of recognition, an example 15 simply says an arrangement covered under India's 9 is not covered over it. Yeah, very simply. That is what you need to do. Okay, now moving on to this recognition part. There's a table which we need to follow. I would suggest if all of you can move on to table on page number 5.41. Okay. And before I get on to this recognition and measurement, there are few terms which are required to be understood by us. Also, very, very important condition. So all of these terms you need to understand carefully, though many of you will be knowing about it. So this is the date. Let's suppose this is the date when the company and employee entered into an arrangement. Wherein employee needs to stay with the company for next years, or let's suppose next 4 years, and perform at the desired level. Okay. If the employee stays with the company and performs at the desired level for next 4 years, he will become entitled to equity shares of the company. So he will get stock option. Please understand, he will not get stock, he will not get equity shares after 4 years. When this condition will be fulfilled, he will get stock option. There's a difference between share and stock option. What is this stock option? Stock option means that employee will have an option to buy the equity shares of the company at a price which is agreed today. Let's suppose arrangement says after completing 4 years, employee will get stock option through which he can buy share of the company at ₹20 per share. Okay. He will be able to buy equity share of the company at ₹20 per share. So this stock option entitlement will arise after 4 years. And after completing 4 years, it's not a mandate to the employee because he is getting an option. It's an option. Option will lie with the employee, not with the company. And employee can exercise his option for which he will again get a time frame. Let's suppose he is given another 2 years. he will get another 2 years, over which he can exercise his option to buy equity shares of the company if he wants. So now, in this example, this period from 0 to 4 is called as the vesting period. Vesting period means period over which condition will be vested. What was the condition? To stay with the company and perform at the desired level. So there was a vesting condition. There is a condition which is vested over here. And when will this condition get vested? On this date. So this date is called as what? Vesting date. This period over which condition will be vested is called as vesting period. When this period will end, that date will be called as vesting date. After the vesting date, exercise period will start. It can be 2 years, it can be 6 months, it can be 3 years, depends on the arrangement. Generally, a big period is available to the employee over which he can exercise. What is it that he needs to exercise? Option to buy equity shares. Let's suppose on this date, employee exercises his right to buy. So this date will be called as exercise date. This date will be called as exercise date. It could be towards the end of the exercise period, it could be towards the beginning of the exercise period. At any point of time, employee can do this. Correct? Now this date, this is the date when the employee and the company entered into an arrangement. What do we call this date as? Grant date. This date is called as grant. Okay, yeah. So there is a grant date, there is a vesting date, there is exercise date, there is vesting period, and there is exercise period. Yeah. Now, other than this, there is another thing which is important, and that is about receipt of goods or services. If you look at this entire period, over this period, what will happen? Over this period, company will be receiving goods or services. Here it's an employee, so that's why company will be receiving the services from the employee. Yeah, company will be receiving services from the employee over this period. Correct? Clear? All of you clear on the terms? If there is any doubt, any question you have on any of these terms, please let me know. Because all of these terms will be very, very important for us to understand the recognition and measurement principles, on which we'll now move. So if you have any doubts around any of these dates, any of these terms, please let me know. Vijay is asking, sir, if the payment is linked to share price of the company for services and goods which are received, then Ind AS 102 will apply? Of course, yes. Questions, any doubts in case you have on this? No? Are you all clear on this? Yeah? So we'll move further then. Now you can all start referring to that table, which is available on page number 5.41. Very important table, you can say, and this summarizes the recognition and measurement requirements. Now the measurement of share-based payment arrangement will be dependent on two things. Means whether the counterparty is employee or non-employee. So at the first place we have company, and on the second place we have this other party. Now this other party could be an employee. Scenario 1, or this other party could be non-employee, which can be the scenario 2. Scenario 1 could be that of an employee, scenario 2 could be that of non-employee. Now, when will the recognition start? The recognition for the goods or services which the company is receiving will start from the day when the goods or services are received. So when will the recognition start? The date when goods or services are received. Okay. But slight confusion may arise on this point. We understand that the recognition has to start from the date of receipt of goods or services. In our example, if we talk about employee, we need to start recognition from this date because employee has started rendering services on this date. So during this period, recognition will happen. And it will start from this date. Okay. Now the question is, how do we measure that? How do we measure that? For the purposes of measurement, now we need to understand what is required to be measured. We need to measure the difference between fair value of stock option and exercise price. Let's try to understand what is the cost to the company. Let's suppose fair value of stock option is 100 in the market. I'm not talking about fair value of share price. I'm talking about fair value of stock option. There will be a difference in these two also, which we'll discuss later, not now. And let's suppose exercise price is 20. We understand that after 4 years, company will get rupees 20 and will issue equity shares. Ideally, company should have received rupees 100 for this, but did the company receive rupees 100? No. So the company lost out on 80 rupees per option. So this 80 is what cost to the company. So over what period this cost should be recognized? Over a period of 4 years, this cost should be recognized. Correct? And against this cost, company is receiving services from the employer. Yeah? Now the question is that when we get onto this fair value of stock option, on which date this fair value of stock option will be measured? Understood? Now the question is, on which date this fair valuation of stock option will be done? In case it's an employee, then the measurement has to be as of the grant date. But in case it's a non-employee, means we are receiving goods from the vendors, then the measurement has to be on the date of receipt of goods or services. Why is this done? I will come to it. Secondly, these are the dates on which fair valuation will be carried out. Okay. When will that valuation start? From this date, but what will be the date which will be considered for the purposes of fair valuation? These two dates in these two situations. Third thing, when we will carry out the fair valuation, on what thing this measurement will be done? When it comes to the employees, we will measure the fair value of equity instruments issued. We will carry out fair valuation of equity instruments issued. But when it comes to non-employees, we need to carry out fair valuation of goods or services. Okay. Now there are two things which are changing in two scenarios and which must right now be a big point of confusion to all of you, and everyone must be thinking, sir, why is this change required in case of employee and non-employee? First of all, to consider different dates for the purpose of measurement, and secondly, to consider the basis of measurement, which are different. Standard clarifies this. Standard says that in case of an employee, measurement of fair value of services which we receive is not reliable. Or we can say that when it comes to the measurement, then the fair value of equity instruments which the company will issue is more reliable as compared to fair value of services which the employee will render. See, there are two things. Either you pick up the fair value of equity instruments which company will issue, or you pick up fair value of goods or services which these parties will supply. Standard says in case of an employee, fair valuation of goods or services which the company receives is not reliable, or you can say is less reliable as compared to fair value of equity instruments issued. That's why in case of an employee, what do you need to use? Fair value of equity instrument which company will issue. But in case of non-employees, this is more reliable. Okay, that's why you will use fair value of goods or services which are received. Okay. Now, because we are using the fair value of equity instruments issued and not the fair value of goods or services which are received, that's why we are taking a grant date over. Grant date being the date on which this measurement will happen, on which you will go to a valuation expert and ask him to do the valuation. The cutoff, or you can say the date which valuer will ask you, that if you want me to fair value this, what date should I pick? That will be the grant date in case of employees. But because we are considering basis of measurement of goods or services received in case of non-employee, that's why this date should also be the date on which goods or services are received in case of non. Are you all clear on this? Yeah? You are all clear on this? I can see some queries from some of you. Pranav is asking, sir, if the payment is made in cash, which is linked to the price of the equity, then whether it's covered under India's conflict? Of course, yes. Vijay is asking, sir, excise date means a date on which employee excising is right during excise period, so it may differ from person to person, of course. Kalyani is asking, sir, what does the employee receive on grant date and option issue date? On excise, he will receive shares. See, on excise, he will receive shares. On grant date, he is getting an entitlement of option. He is receiving an option for which he needs to complete the conditions. Bhargavi is asking, sir, that means in case of non-employee, measurement is to be done on vesting date? No. Measurement is not on the vesting date, because before the vesting date, goods or services will be received. So it can't be on vesting date. It has to be before vesting date. Okay? Because goods or services will be received before the vesting date. It cannot be the vesting date. Clear? Yeah? Okay. So now, I think you will get more clarity around all of these principles when we pick up one example. So that's why I think it will be good to pick up one small example to which you should get some more clarity. Let me find a very, very simple example for all of you. Okay, great. So we can move on to illustration number 1. Illustration number 1. I think very, very simple, and this will help all of us to get some clarity on the concepts that we have discussed. Illustration 1. See, in the illustration, a terminology has been used: equity settled, cash settled. All of these terms, for the time being, please ignore. For the time being, we'll just go by the things that we have discussed. Please don't create confusion in your mind by getting onto different terms which we have not discussed. All of these things will be discussed, but with the understanding of some of the basic concepts that we are discussing right now. Question is asking, sir, in the table for employee, the recognition date is the date of goods or services received? Yes. See, the date of recognition and date of measurement are different. Okay, those are not same. Generally, they will always be same. Generally, you will find that to be same, but at times they may be different. I will clarify on that one first. Okay, but I'll break. All right, so we can take a break now. I can understand. I have just stressed this session. Okay, no problem. So what we can do is we can now take a break of 10 minutes. After the break, we will continue with the same discussion, and as I have told you, you will get more clarity around this concept with the help of this illustration. Through this illustration, you will try to understand the meaning of measurement. You will also try to understand. You will also hopefully understand as to what does this recognition mean, when does it start, and how does this really apply to all of those concepts that we have discussed. In the meantime, if you want to practice this illustration one, you will do it on your own. Otherwise, anyways, after the break will pick up. But as I told you, please don't get into these terms, equity settled, cash settled. For the time being, please ignore. I'll get on to those terms at the right time. Okay. Pranav, as a query is asking, sir, for employee measurement is done or granted, then later, if employee doesn't exercise the right, then what will be the treatment for the cost which has been recognized in the company's books? I can see all of you, in fact, most of you are jumping onto the topics we have not yet discussed. Please hold on your thought for some time. All of these things we'll discuss. As I told you, all of these terms we'll discuss. Please wait for some time. Okay, yeah. All these things will be picked up. Ram? Ram? All right. Hi, welcome back. So we'll now continue with our discussion. We were discussing about the recognition and measurement principles. So we'll start with this illustration number 1. ABC Limited granted to its employees share options with a fair value of rupees 5 lakh on 1st April 2000 X0. Fair value of the stock option is given to us. So fair value of share options is 5 lakhs. Okay. Condition is that the employee should stay with the organization up to 31st March X3. So this is first year, second year, third year. 31st March 2000. 1st March is 1. 1st March is 2. Okay. On 31st March X1, that means this year, ABC Limited expects only 91% of employees to remain in the employment. So entity doesn't expect all the employees will continue. Only 91% will continue. So I think this was also one of your queries on what if the employees leave the organization before completing this vesting period. So what's the vesting period over here? Can any of you tell me what's the vesting period? Quickly. On 31st March X2, company expects only 89% of the employees to remain in employment. Here, this expectation has changed to 89%. However, only 82% of the employees remained in the organization at the end of 31st March X3, and all of them exercised their options. Here, actually, 82% stayed, and they also exercised their right. So now, before we get on to the solution, can all of you tell me, please, what is the vesting period? Quickly, what is the vesting period and what is the grant date? Quickly, some of those terms which we discussed. What is the vesting period? What is the grant date? You can also tell me what is the vesting date? What is the exercise period? Quickly, I'm waiting for a response. Vijay is saying vesting period is 3 years. What is the grant date? What is the vesting date? What is the exercise period? All of you, I'm waiting for a response. Quickly. Mayur is saying 3 years is the vesting period. What about others? Grant date. Tell me what's the grant date? Tell me what's the vesting date? What is the exercise period? Shalka is saying 1st April 2000 X0 to 31st March X3 is the vesting period. Okay, so this point is, I think, clear to all that this is the vesting period. But what other things? Grant date, vesting date. Grant date is 1st April 2000 X0 as per Mayur and Vijaya. What is the vesting date? What is the vesting date? What is the exercise period? And also tell me the date when the company starts receiving services. In this case, it's an arrangement between company and the employee. So no goods are received. So what's the date when the company starts receiving services from the employee? All of these things are very, very important. Okay. Tell me. Okay. Rather is saying grant date is 1st April X0, vesting period is 3 years, exercise date is 31st March X3. No, this is the vesting date. This is not the exercise date. But yes, by chance, you may assume this date to be the exercise date also, because the exercise date is not given in the question. Okay. Pranav is saying vesting period is 3 years, exercise date is 31st March X3. So this assumption can be taken. But what is the exercise period? This all is the exercise period. Means after the vesting date, it can be exercised. Okay. Now, when are the services received? Over this period. Over this period, services are received. And when did the company start receiving services? On this date. Company started receiving services. Now, in this case, what is the cost to the company? For this plan, what is the cost to the company? Cost to the company is the fair value of the stock options. In the exam, this fair value of stock options will be available to you. You will not be required to compute this fair value. Okay. So now, what should be the accounting treatment? So now let's try to understand the accounting treatment. For entry into this arrangement with the employees, company will be required to incur a cost of 5 lakh. So two treatments are possible which come to my mind. First, this arrangement is done on this date. This is the date when agreement has been finalized, scheme has been finalized amongst the company and the employees. So book this cost upfront on day one, entire 5 lakh, book it and charge it to P&L. First option. Second option, because this cost pertains to 3 years, this cost doesn't pertain to only this date. Why? Because employees are rendering services and this cost is getting incurred. So that's why book this cost of 5 lakh over a period of 3 years. This is the second option. For the purposes of Ind AS 102, you don't book it upfront. You are required to book this cost over the period of 3 years. Understood? What is the accounting treatment we are required to do under Ind AS 102? Booking this cost over a period of 3 years. Which is very, very simple. Very, very simple to be done. Yeah. So what should we do? 5 lakhs divided by 5 lakhs divided by 5 lakhs divided by. Okay. Simply, this should be the cost which should go to P&L. Yeah. Ideally, this should be the cost which should go to P&L. Year on year. Now, this is the cost which will go to P&L year on year if this is the cost which should go to P&L year on year if all the employees are expected to stay with the company and they actually stay with the company till the end of this vesting period. But practically this doesn't happen. And even in our question, this is not happening. So can we attribute this entire cost towards this arrangement? No. Why? Because out of this 5 lakh, cost pertaining to 9% of the employees did not exist. Why? Because those 91% of the employees left the organization. They left the organization. So out of this 5 lakh, only 91% of the cost will stay. At the end of first year, what will the company expect? Cost to be 5 lakh into 91%. Okay. So what is the amount equivalent to 5 lakh into 91%? Whatever amount this comes out to. Now this is the total cost which the company will expect for 3 years. So this is the cost which the company will expect for 3 years. So that's why this should be divided by 3. So what's the amount that the company will get? 1,51,667. This will go to P&L. Okay, this will go to P&L. Now, moving on to next year. Next year, the expected number of employees further went down. Next year, it went down to 89%. Okay. So now what will be the cost? Cost will require revision. But whatever cost we have charged to the P&L in the first year, can we change it? No. We cannot change it. Whatever cost we have charged to the P&L in the first year, we cannot change it. So what do? 5 lakh into 89% will be computed. Okay. And 5 lakh into 89% will be the cost for how many years now? The remaining 2 years. So we'll say into 2 by 3 into 2 by 3. Correct? So we'll get some cost. From this cost, what do we need to do? This much cost is already booked. This much cost is already booked. So what are we left with? 1,45,000. This amount goes to our P&L. In the second year, what is the amount which will go to P&L? This much. Okay. In the third year, this amount will further be changed. Why? Because now the number of employees has further gone down. And now we are left with only 1 year. So we'll say into 3 by 3. So we'll get some amount. Out of the amount that we get, this much cost is already booked. So what are we left with? We are left with 1,13,330 to be charged to P&L of the third year. So by doing this, what will happen? You will see over a period of 3 years, this plus this plus this will be the cost which has gone to P&L. Year on year, the amount may not match. Why? Because the expectation which the company had has changed year on year. If the number of employees increased with you as yet, okay, I have only discussed the accounting treatment in terms of the impact which will go to P&L year on year. How is that required to be completed year on year? Are you clear on that? If you have any questions, any doubts on that, please let me know. I think Shalika computed this on her own. Very good. Then I have this query from Kalyani. Kalyani saying, sir, is it that in this case, nil amount receivable from employees, therefore full, yes, that's correct. That's correct. Anuj Vijaya, am I clear? Is the video all clear? I can see a couple of your queries regarding the video. Ram, video is all clear? It's getting stuck? Are you all clear? Please quickly confirm. Is the video all clear? Video is all clear. Perfect. Okay. Yeah. So are you all clear on this? Any questions in case you have on this, please let me know. All of you, please tell me. Okay. So she's saying, can this vesting period be further extended? Yes. At times there could be changes in these type of arrangements, because of which vesting period can be increased, exercise period can be increased, this exercise amount can be, this strike price or this exercise price can also be increased, which are called as modifications. Okay. You don't need to get into that right now. Vijay is clear on this. Okay, great. Kalyani is asking, sir, could you please explain second and third year treatment since the video got stuck? Very simple. In the second year, what are we doing? We are changing the estimated expense from 91% to 89%. For 2/3. Why? Because this is for 2 years now. So whatever amount we get out of this expense which has already been booked in the first year will exclude. So what are we left with? 1,45,000. Same principle will follow in the third. Okay. Now I will take you to two terms or two types of arrangements into which share-based payment arrangement can be categorized. We understand that in this example, the arrangement that we have discussed was share-based payment arrangement. Okay. We understand that at the end of 3 years, what is it that the employee is getting? Equity shares. How do we get to know about it? It says company granted share options and all of those options were exercised by the employees. It doesn't say that the company has paid cash. Okay. So you can also say it's assumed. What is it that's been assumed? That the company has issued shares to the employee at the end of third year or on vesting date. Okay. Now let's look at it from the perspective of the company. Now this is very important, the perspective of the company. I'm not looking at the perspective of the employee or the other party. I'm looking at the perspective of the company. Company will always have two options. First, to issue equity shares, or you can say equity instruments. I'm sure after doing financial instruments, you will be knowing that equity instruments are not limited to equity shares. So first option is that at the end of third year, company will pay or company will settle by issuing equity instruments. Second option is that company will not issue equity instruments or company will not settle through equity instruments. Instead, company will pay cash. If you remember, cash as an option is also available to the company. The only thing is that this cash has to be linked to equity instruments. This is the only condition. But cash can also be paid by the company. So the company can do this. That company can pay cash equivalent to this much amount. Company can pay cash equivalent to this much amount. Why? Because this much amount is linked to the shares of the company. How is this computed? By linking it to shares of the company. Okay. So two options are available to the company. Now, whether the company will settle through equity instruments or through cash, This is again something which is decided on this date itself. On the grant date itself, company will agree with the employee or with the other party. How will the settlement take place? Yes or no? Let's suppose if you are party to the contract, you would always like to know from the company how will you settle it? Will you issue equity instruments or will you pay me cash which is linked to the equity shares of your company? How will you settle it? Yes or no? Yeah. If we say that equity instruments will be issued, then such type of share-based payment arrangement is called as equity settled. Means the one which will be settled through equity instruments. The other one, which is settled through cash, is called as cash settled share-based payment arrangement. Why? Because that will be settled through cash. Understood? Yeah. Now, for these two type of arrangements, equity settled or cash settled, I need to take you back to financial instruments. Particularly Ind AS 32. Do you all remember Ind AS 32? Quickly. I'm hoping you'll remember. Do you remember a concept which you would have discussed over there? Financial liability versus equity. Debt versus equity. Tell me quickly, how many of you remember that? Because that concept is required to be applied now over here. And you may be thinking, but sir, we are doing Ind AS 102. Still, you will have to use those principles over here. And if you remember those principles, this will become very, very easy. Because with the help of those principles, I will need to draft journal entries. Okay, that's why I'm waiting for a response quickly. I'll come to your queries slightly later. Anuj, Bhargavi, please hold on your queries. Let me get done with this part, then I'll come to your queries. Praveen, please wait. Please tell me quickly. Do you remember debt versus equity? Can you share thoughts about debt versus equity? What was debt? What was equity? How was debt required to be assessed? Can you draw some linkage of debt versus equity to this? Quickly, I'm waiting for your responses. Ram, can you please check the video on? Students are saying it's getting stuck. Is the video all clear? Tejal is saying video is getting frequently. I think you need to check it at your end. Maybe because your connectivity is not so good, this may be getting stuck because I can see no other queries from any other student. Yes, quickly on to debt versus equity, please. I'm waiting for your responses. Quickly. Do you remember that part? Do you remember that part? No response. Alright, so let me just take you back to those principles. What was a financial liability? If you look at financial instruments, wherein issuer cannot avoid obligation to pay cash in simple terms. Remember, that was a financial liability. And wherever issuer can avoid payment of cash, that used to be called as equity. Remember? Now applying those same principles over here, The moment we say that today, on 1st of April, when the entity has agreed with the employees that this settlement will take place through cash. So what do we call this cash as? This will become financial liability. Yes or no? This will become financial liability for the company. But over here, because the company will not be required to pay cash, company will be required to issue equity shares or equity instruments. So what will this become for the company? Equity. Secondly, equity is not remeasured. Equity is not remeasured at every reporting date. But financial liability has to be remeasured at every reporting date. And this financial liability will be the one in the nature which will have to be measured at fair value. Yes or no? Can we say that this financial liability will be the one which will be measured at amortized cost? No. This financial liability which will arise over here will be the one which will have to be measured at fair value. Correct? Yeah? Clear? Okay. Now using these principles, I just wanted you to explain to me, but I am not sure as to why you don't remember. I would suggest all of you please make sure you are revising these concepts, because Indias is completely interlinked. There are a lot of principles within various Indias which are interchangeably used. Now we can go to the accounting entries in the same illustration. Sapna is asking, okay, Sapna is saying debt means obligation to pay cash, which will arise over here, which is not fixed to fixed, which is over here. But in case of equity, if the fixed to fixed criteria is met, fixed for fixed criteria is met, then it will remain equity and it will not become financial liability. Great. Same is the response from Pravi. Okay, great. Now using the same principles, what do we need to do? We need to get into the accounting entries. So let's see what will be the accounting entry here. In the first year, that means 31st March X1, what is the accounting entry that company will pass? This much amount will go to P&L. So this will go out as share-based payment expense, employee benefit expense, whatever you want to call it, you can do that. Okay. So your study says employee benefit expense. There. What's the amount? 1,51,667. The first March to equity. Now in this case, what do we say? The settlement is through equity shares. That's why we will not create a financial liability on the part of the company. We will create equity for the company. And this equity may be called by a different name. What name can be assigned to this? Various companies, various corporates call it by different name. Some of them will call it as ESOP reserve, some of them will call it as other equity, some of them will call it as share-based payment reserve. Your study material calls it as share-based payment reserve. 1,51,600. Okay. Okay. Yeah. Okay. Now moving on to the second year. Second year, once again, same accounting entry will have come, but the amount will change. Now this will be 1,45,000. Now this will be 1,45,000. Similarly, in the third year, same accounting entry will have been passed, but the amount will change. 1,13,333. Okay. And eventually what will happen? Now, if you look at year on year, the reserve or the equity has got accumulated to this plus this plus this. What was that amount? 4,10,000. Now, in the balance sheet at the end of third year, company has equity amounting to 4,10,000. But that equity is not the share capital. That's a kind of reserve which the company has generated. So what will the company be required to do? This equity which the company has accumulated over a period of 3 years will have to be debited 4,10,000, against which company will issue equity shares. 2. Equity share capital 4,10,000. Correct? Clear on this? Easy to understand. Can you see how easy it was in terms of the accounting entries? All of you clear on this? Any questions that you may have on this, please let me know. Simple, easy accounting entries, yes or no? Tell me, accounting entries were easy and simple to understand or not? If you have any doubts, please let me know. Okay, Praveen has a query. Praveen is saying, sir, it means the employees who were in employment on 2001, X1, this option will apply on them only, because it may happen that new employees also join between. Those employees who are in employment on X3, those will get the shares. Yes, that's correct. But please remember that if the new employees will come, those will not get added to the scheme. Why? Because the scheme will apply to only those employees who existed on this day and continued up to this day. If any of them will leave, those are gone. If let's suppose new employees come over here, they will not get added to the scheme, because the scheme requires 3 years stay. And that too should start over here. If new employees come, they also get similar sort of scheme. That will be a different scheme. That will not be this. Okay. Anuj is asking, sir, what if all the employees are completing the vesting period, do not exercise option? Nothing. This reserve will continue in the balance sheet. Then this accounting entry will not be passed. Simple. Okay. This reserve is a reserve which will stay. You will not reverse this reserve. In any ways, it's a sort of reserve in the balance sheet. Huh? Sapna is clear on this. Very good. What about others? Any more queries? Shilka is saying clear, but at the time of grant date, decided that settlement in cash or equity. Yes, as I told you, that the scheme will have everything clarified. Whenever any scheme is rolled out, that will have all of these aspects clarified. It will not happen that clarity to settle in cash or equity will be missing on this trade. No, it will not. Okay. Let's move on to illustration number 2. Page number 5.3, illustration number 2. Here again we have got 3 years, but I think we have some different type of arrangement, and the numbers are also different. XYZ issued 10,000 share appreciation rights that vest immediately to its employees on 1st of April 2000 X0. On this date, share appreciation rights are given. And these rights will be settled in cash. Shalika, I think this was your query. See, it's clarified that share appreciation rights will be settled in cash using an option pricing model. At that date, it is estimated that the fair value of one share appreciation right, that is share appreciation right, again, it's a kind of stock option, that its fair value is 95 rupees. For one stock option, you can say it's 95. Share appreciation right can be exercised any time up to 31st March X3. Up to this date, it can be exercised. At the end of the period on 31st March X1, it is expected that 95% of the employees will exercise this. At the end of second year, it is expected that 92% will exercise this. At the end of 3 years, it is expected that 89% will exercise this. Okay. Fair values at the end of each period have been given. For some reason, fair values of share appreciation right are given. We'll have to see why these fair values are given. It's 112, then it changes to 109, then it changes to 114. Okay. You are required to give this complete accounting treatment to this arrangement. Anuj is asking, sir, what if we issue preference against services, preference shares? There's no problem. Again, you'll have to analyze whether it is going to be an instrument in the nature of equity or cash. And that's what I'm telling you. Now your understanding of principles of Ind AS 32, that is debt versus equity, will have to be applied over here. Okay. Now in this case, let's try to understand. Is there an obligation on the part of the company to pay cash under this arrangement? Yes. Even though share appreciation rights are there, those will be settled in cash. So it's an obligation to pay cash. So what will this result into? Equity or financial liability? Financial. Okay. Now, number 2. Financial liability is not something which will not be remeasured. In illustration number 1, you should have seen equity was not getting changed. We were not remeasuring equity. Amount remained same. The only thing we changed was because of increase or decrease in the number of employees. In fact, this was only decrease due to number of employees, but we did not remeasure equity. Now, because we will have a financial liability, so that's why this will not only change because of number of employees, that will also have to be remeasured at every reporting day. Okay, yeah. Then I think Shri Ranjini is asking about share appreciation rights. Share appreciation rights very simply means that over this period, employees can get this converted into shares against which company will issue cash or company will pay cash. That's a share appreciation right as per this arrangement. Okay. It's a kind of stock option, you can say, but which has vested over it. Okay, clear? Okay, now what do we need? Year on year, we need to look at the amount. So what's the total amount which is expected over here? 95 into 10,000. So this will be 9,50,000. So on this date, what's the expected liability on the part of the company? 9,50,000. And this is on the basis of an assumption that 100% employees will continue. But at the end of first year, do we have 100% employees? No. How many employees do we have? 10,000 into 95%. 10,000 into 95. So the number of employees have gone down. First. Secondly, what's the amount of expense that we need to book? This divided by 3. This is, 95 into 10,000 into 95% divided by 3. Can you please compute this amount? So this will be 9,50,000 into 95% divided by 3. What do we get? We get 3,833,000. That's the amount that we get. Okay. But let's now understand over here. Over here, our liability at the year end, is that now equivalent to 95? No. At the end of first year, the amount of liability has also got changed. This has got revised to 112. Correct? So now at the end of first year, if I recompute this, what do I get? 112 into 10,000, 11,20,000 into 95%, 10,64,000 is the amount of liability. Correct? I will just remove this. 10,64,000 is the amount of liability. Yeah. Now the way we need to book our expense is going to be slightly different. On day 0, we expected our liability to be this much. Excuse me. Yeah. But this liability has got changed to 10,64,000. Correct? Yeah. So what is it that we need to consider? 10,64,000 minus 9,50,000. What is it that we get? 1,14,000. So this will be the expense for the first year. Now please try to understand why are we doing this. In illustration number 1, if you see, our vesting period was 0 to 3 years. But now we don't have this vesting period. Vesting has got completed on this day itself. So that means within the vesting period we need to book the expense. If our vesting period is only 1 day, what do? We will book this expense on this very day, equivalent to 9,50,000. So this is the amount of expense as well as the liability on this date. After that, till the time it is not exercised, liability is getting updated. There is a revision in the liability. And that revision in the liability, as per financial instruments, where do we take it? P&L. Yeah? So that is exactly what we are doing. We are just throwing up our liability and any impact due to change in financial liability. This is a financial liability. We are taking it to P&L. So this is the impact which goes to P&L. Now, moving on to next year. Now, next year, this 112 has become 109 and the number of share appreciation rights has also gone down. Because of which, the total amount of liability has gone down. It has become 10,02,800. Now there is a revision in the liability from 10,64,000 to 10,02,800. So there is a decline in the liability. So this decline is what? 61,200. Where do we take it? Again, we take it to P&L. Now this will not be an expense. This will be an income because the liability has gone down. In the third year, this has become 114 into 10,000 and actually the number of employees became 89%, because of which this became 10,14,600. Is now because of this, further revision in liability will arise equivalent to 11,800, which will also go to claim. Okay, clear on this? Yeah. So these four are the amounts which will go to P&L, and every time an account goes to the P&L, liability gets trued up. Or you can say because of revision in the liability, the P&L impact is recorded like this. Correct? Yeah. Why are we required to do this, which was not done in illustration number 1? If this was a case of illustration number 1, if this was a case of settlement in equity, then we won't revise this 9,50,000 year on year. This will remain fixed. No change will arise over here because of the amount. The only change which will arise will be because of number of employees. Okay, clear? The way we do it in illustration number 1. Now the added impact for this revision in the liability is due to the fact that it's a liability. It's a financial liability. Clear? Any questions? Any doubts in case you have on this? No? So let me just pass accounting entries also. So in the first year, on the first date, what is the accounting entry will pass? On 1st of April 2000 X0. We will again say employee benefit expense debit to financial liability. Financial liability. And we can name this financial liability. Study is calling it as share-based payment liability. Share-based payment liability. This is 9,50,000. 9,50,000. Okay. At the end of year 1, that means 31st March X1. This expense will increase and the liability will also get increased. 1,14,000. 1,14,000. At the end of second year, 31st March X2, now the liability will get reversed by this. Why? Because liability has gone down. So what do we say? Financial liability debited 7,200 to employee benefit expense 61,000. Correct? Number third year, what do we do? Again, expense will be booked and liability will increase. 11,800. 11,800. And after this, what will happen? Now we have accumulated liability, or we can say cumulative liability amounting to 10,14,600. 10,14,600. This will be debited and this will be settled through cash. So we can say to bank or cash. 10,14,600. Okay. Clear on this? So these are the accounting entries that we will require to pass in case it's a cash settled share based payment arrangement. The only thing which you need to remember in the exam is that over here we have booked this entire expense on day 1 because it got vested on day 1. If this vesting would have been over 3 years, then you would have applied the same formula of dividing by 3. Okay. Anuj and Praveen have got queries. Anuj is saying, sir, what if we are required to prepare interim financial statements? We are required to calculate liability on interim reporting date? Of course, yes. Ind AS 102 accounting has to be done whenever Ind AS financial statements will be prepared or whenever interim reporting will be done as per Ind AS. So there is no exception on this principle as regards interim financial reporting. Okay. In fact, even if you look at interim financial reporting, the only exemptions which that standard provides is on presentation or on disclosures. On recognition and measurement, it doesn't provide any exceptions. Okay. Praveen is asking, sir, in that case, does it mean that employees will get cash and share appreciation rights also? Company will pay for its shares to the employees? Please understand that employees have been given a right today. On this day, employees have got a right. What is the right? To get an amount from the company equivalent to rupees 95 per share. And how many rights are there? 10,000 rights are given. You can say 10,000 number of instruments are given. That's okay. So when the employees will come, they will show their instrument to the company and company will keep the instrument with itself and pay cash. That is called as cash settled instrument, which is the case over here. Suishi is asking, can we interchangeably use financial liability instead of share-based payment liability? I would advise you not to do this. You should be consistent in terms of the terminologies that you use. See, there is one mistake which I have done over here, and I would call it as a mistake. Why? Because at once I have written financial liability bracket share-based payment liability. Then I have written only financial liability. There is inconsistency in the term which I have used. Ideally, one account should have same and which should continue throughout your solution. This is a shortcut which I have adopted. But please remember, if you do this in the exam, this will only irritate the exam. So you should try to avoid this. First. Secondly, you should try to use the same terms which your study material is using. That is always appropriate. Okay, just try to stick to the same terms which study material is using, or maybe if any term is specified in the question, then you should go by that. Otherwise, try to follow the terms which are used in study material. That is always considered to be better. I'm not saying using other terms will be wrong, but this will be considered to be better. Okay. Mohammed is asking, sir, it is vested on day 1 means 4 years period is exercise period, right? Yes, that's correct. In this case, if you look at it, 4 years period is the exercise period. And that's why over this period we have continued with this liability, and that got revised. And after this period, in fact, this was not 4, this was 3. After this period, this liability was settled. It's gone. It doesn't remain anymore, because this is the maximum period over which this will require to be kept. Alright. Any more questions, any more doubts in case you have on this? Okay, now, as regards share-based payment arrangement, I told you there are 2 types, equity settled and cash settled. However, another type exists for share-based payment arrangement, which is, you can say, a third type, but for which you don't need to understand new concept. All the concepts that we have discussed for equity settled and cash settled will be used in that third type of settlement, and that is called a share-based payment arrangement with cash alternative. Okay, I'm not getting into the details of this one. If you want, you can just study this and practice questions, because as I told you, the concept of these 2 type of arrangement will be applied in this third arrangement, and same accounting entries basis that concept will have to be used. We will pick it up in the next session, because we are moving towards the closure of our session now. So if you have any questions, any doubts as around whatever we have discussed, please let me know. The remaining part of this topic we will complete in the next session, and hopefully we'll be able to wrap up this topic in the next session itself. Okay, yeah. So over to you now. If you have any questions, any doubts, please let me know. After which we can wind up our session. Question is asking, sir, if settled in equity, then it should be recognized as equity, and if it's settled in cash, it should be recognized as financial liability. Why there is a difference? For this, you need to understand the concept of debt versus equity, which is covered under Ind AS 32. Which says, I'll just touch upon it, which says that if a company can avoid payment of cash, if company issues an instrument, and through that issue of instrument, our company is the issuer, company will be able to avoid payment of cash, then such an instrument will become equity. Otherwise, it will become financial liability. Same concept we have applied over here, and because of which we are saying the moment we are required to pay cash, it will become a financial liability, otherwise it will remain equity. And for these 2 different types of instruments, accounting treatment is different. That's why we have to apply different accounting treatment. You can say this concept is very much linked to the concept of financial instruments. Okay. I'm assuming that maybe you have forgotten those principles and we have not covered that. So it will be advised that we go back to those principles, cover that, you will get more clarity around it. Anyways, I just touched upon those points. Fine. Any more questions? Anuj is saying, sir, kindly repeat why liability on the grant date is deducted from reporting date liability, even when we didn't book liability on the grant date or we passed any entry on the grant date. See, in this scenario, on grant date, we have recorded this liability. Because this was not only the grant date, this was also the vesting date. And we also passed an accounting entry. Maybe you missed out. Go to the study material, accounting entry is also passed. Because this was also the vesting date. If you look at the question, read this. XYZ issued 10,000 instruments that vest immediately. They got vested immediately. There was no vesting period. That's why we have done it over here. Otherwise, as I told you, over the vesting period, you will book this expense. Okay, clear, Anuj? Yeah. Okay, question is clear on this, and I'm hoping the same for Anuj. All right, yeah. So we can then end this session over here. If there's still any queries of yours, I don't see it over here, but still, if you think there's any query that is left, please put down your query and we can discuss that query in the next session. So thanks to all of you once again for your time and for your wonderful participation. We'll meet in the next session and we'll wind up this topic in the next sessions. Okay, thanks so much. Done. Yes.